Canadian sales taxes could apply to your business without you even realizing it. Is it 5% GST, or is it 15%, or 9.975 QST? Even seasoned accountants and bookkeepers often struggle getting this right. But the cost of mistakes when it comes to Canadian sales taxes can be massive and irreversible. So today, we will tackle one of the most challenging areas of the Canadian tax system. I will simplify the complexity into something you can actually use to protect yourself and your business from very costly mistakes. I will also provide 5 super helpful tips that could save you literally thousands of dollars in taxes and penalties and hours of wasted time. By the way, I'm Alex. I've been in accounting and finance for over 15 years. I have top professional designations, and helping business owners navigate taxes and business challenges is what I do pretty much all day long. Now, if you're thinking, Alex, I already know this stuff. I charge GST, I file my returns, what's the big deal? Here's what many business owners don't realize. Canadian sales tax isn't just about charging the right percentage. It's about knowing when to charge, where to charge, what to deduct, and how to set up the system to actually save money instead of just paying it. Did you know that you might be able to get tax refunds even when you have no sales? Or that choosing the wrong filing method could cost you thousands in unnecessary taxes? Or did you know that CRA can actually decide for you what taxes you owe them if you don't file on time? Many business owners learn these lessons the expensive way, through penalties, audits, and lots of stress, wondering what went wrong. But you don't have to. By the end of this video, you'll understand Canadian sales tax better than many accountants. It's impossible to cover every detail of the Tax Act in one video, but my goal here is to provide you with enough information to know what to watch out for and to have educated conversations with your accountants. Of course, no single video, no matter how detailed, can replace professional tax advice. With that in mind, let's dive in. Let's start with the basics because so many business owners get this wrong from day one. Canada has this thing called GST, Goods and Services Tax. It's a 5% federal sales tax similar to a value-added tax in other countries. Simple enough, right? Well, not quite. GST is a 5% federal sales tax, but in some provinces, it's combined with a provincial tax to create HST, Harmonized Sales Tax. It's the federal rate plus the provincial portion, simplified into one payment, like a combo meal at a fast food chain. Convenient, eh? Here's where it gets even more interesting. As of 2025, Alberta, Yukon, Northwest Territories, and Nunavut keep things simple. Just the 5% GST. But not every province plays along. Ontario charges 13% HST. Nova Scotia is 14% now. And New Brunswick, Newfoundland, and PEI all charge 15% HST. When a province charges HST, it means there's only one filing, one rate, one payment to CRA. But then you have the rebels. British Columbia, for example, does not participate in the HST program. So they charge 5% GST plus 7% PST, their own provincial sales tax program. 2 separate taxes and 2 separate filing systems. Saskatchewan does 5% GST plus 6% PST. Manitoba is 5% GST plus 7% PST. And French-speaking Quebec, well, Quebec had to be different, right? They charge 5% GST plus 9.975% QST. And you don't even pay the QST to CRA, you pay it to Revenue Quebec, which is their own tax regulator. Also, be mindful that provincial tax rates occasionally change, so it's important to keep an eye on the government updates to ensure your accounting system is set up correctly. Now, here's where most business owners get very confused. Many think that if they are in Ontario, for example, they'll charge 13% to everyone and call it a day. But you charge tax based on your customer's location, not yours. So if you are in Ontario and selling to someone in Alberta, you charge 5% GST. If you don't know your customer's location, then yes, charge the 13% HST of your province. Very exciting, right? And it gets even better. Canada divides all products and services called supplies into 3 buckets. First, regular taxable supplies. This is the largest category where the regular rate in your province applies. Second, exempt supplies, where no tax is charged at all. Most healthcare services, educational services, legal aid, financial services, childcare, and a couple of others. Residential rent is also generally exempt, but some short-term rental businesses, like when you list your cottage on Airbnb, are taxable. And third bucket is zero-rated supplies, where you charge 0% tax. Most exports, basic groceries, prescription drugs, and certain medical devices are in this bucket. Actually, think about your business and what you sell for a second. Have you done your research to make sure you are categorizing your revenues correctly for sales tax purposes? Now, you might ask, what's the difference between exempt and zero-rated supplies? Same thing, right? No sales tax. But there's a big difference between zero-rated and exempt supplies, and the difference is whether you claim ITC on those supplies. ITC stands for Input Tax Credit, and it's an extremely important abbreviation to keep in mind. Frankly, CRA has made it sound more intimidating than it is. I would just call it something like a sales tax deduction, but what do I know? Anyway, let me explain. Every time you file your sales tax return, you need to remit to the government the taxes that you collected minus ITCs. You only need to remit the difference between the sales taxes that you collected and the sales taxes that you paid to others. You see, in Canada, you essentially collect sales taxes on the government's behalf. Every time you sell something taxable, you need to add sales taxes into a bucket that you'll need to return to CRA. But that bucket doesn't just increase. Every time you pay GST or HST to somebody else in the course of running your business, it reduces what's in the bucket. That reduction is called an ITC. Input tax credit. So at the end of the year, you only pay the difference between the sales taxes that you collected and the ITCs. Now, let's go back to the main difference between zero-rated and exempt sales. If you only sell exempt supplies, you generally don't even register for a GST HST account. There's no sales tax bucket, which means that every time you pay sales taxes to others, there are no sales taxes to reduce. But if you sell zero-rated services or products, you do have a sales tax bucket. You just don't add anything to it when you make a sale. What about the ITCs then? If your bucket is empty and you're still paying sales taxes to others, does it mean that your bucket becomes negative and you can get a refund? The answer is yes. If your sales tax bucket has a positive balance at the end of their reporting period, you must remit that balance to CRA. But if it's negative, you can actually request a refund for the ITCs. The government will ask you to support the balance, so you have to be diligent in calculating it. We'll talk about it later in this video. What if you sell a mix of taxable, zero-rated, and exempt supplies? You actually have to calculate what percentage of your business generates which revenue, and which ITC relates to which revenue. You can only claim that percentage of your input tax credits that result from you generating taxable sales, or zero-rated for that matter. With exempt sales, because you do not claim ITCs, sales taxes you pay to others generally become the non-recoverable cost of running your business. As you can see, there's a lot of rules, and many business owners learn these rules the expensive way. However, sales tax may not even apply to you, at least not yet. So in the next section, let's figure out when you actually need to register for GST HST in the first place, because believe it or not, registration is not always mandatory. So when exactly do you need to register for GST HST? The answer depends on what kind of business you're running and what your revenue is. Most businesses have to register when their worldwide taxable and zero-rated revenues exceed $30,000 in any single calendar quarter or in 4 consecutive quarters. You see how I said 4 consecutive quarters and not in a calendar year? That's right, it has to be 4 quarters in a row. Notice I also said worldwide. So if you're selling something in Canada and the United States, both countries count toward that $30,000 limit. The effective date of you becoming a taxable supplier is the date you first cross that $30,000 threshold. Some businesses don't even get to wait for $30,000. Taxis and ride shares like Uber drivers must register for the first of revenue. No threshold, no exceptions. But what if you don't need to register right away and you're below the $30,000 threshold? Can you still register? Yes, you can. But why would you? Well, there are actually two main reasons. First, if you have a GST HST account, you can recover ITCs on expenses and startup costs, even if your company isn't making any profit. And if you're spending significant amount before generating revenue, voluntary registration might save you thousands. Second, if your customers are mainly other businesses registered for GST HST, they can claim back the tax anyway. So charging GST HST doesn't hurt your competitiveness, but it does make you look a little more established instead of appearing too small by not charging sales taxes. However, if your customers are individuals, then it does mean the prices they pay will be higher due to the sales taxes if you register. Individuals or businesses who are not registered for GST HST cannot claim ITC refunds. So keep that in mind. Whether you register voluntarily is often a judgment call that your accountant can help you with. Once you register, you must collect and remit GST HST on all taxable sales until you formally close the account. Now, let's talk about the setup. Your CRA GST HST account uses a 9-digit business number with an RT extension. So your sales tax account looks something like this. You can register through the CRA website or by calling them. I left the details in the description. Or your accountant can register you. Once approved, I recommend doing 3 things. First, confirm the effective date for your first return. Getting this wrong could result in penalties. Second, set up your accounting system with correct tax codes for each province. And third, I strongly recommend setting up a separate bank account to keep the taxes you collect. The sales taxes you receive are not your money. They belong to the government. And you have no idea how many business owners forget this only to realize they've spent the taxes they collected. Also, your reporting frequency depends on revenue. You have to file monthly if your revenue is over $6 million annually. Between 1.5 million and 6 million requires quarterly filings, and under 1.5 million you can file annually. But you may still need to pay tax installments if your net tax exceeded $3,000 last year. Keep in mind that if you own multiple companies, you may need to match the minimum filing frequency across all your associated companies. So if one of your companies is required to file quarterly because it has $2 million in revenue, your new company might also need to file quarterly, even if it's just starting up. Now that you're registered, the real work begins. You need to charge the right tax rate to the right customer, invoice properly, file on time, and keep CRA happy. For your own sake. Let's start with charging correctly. Remember those place of supply rules? For products, you charge tax based on where you're shipping to. If you get this wrong, you'll either owe CRA money or have to refund customers. Your invoices need specific information as well. It needs to include your legal business name and address, invoice date and number, description, price, the tax rate or amount, and your GST HST registration number. If you miss any of these, CRA might reject the invoice. That will make your customer unhappy because they can't claim that ITC anymore, and it won't look good on you. Also, as we discussed in the previous section, don't forget that the sales tax you collect belongs to the government, not you. So it's a good idea to have that separate bank account. Now, let's talk about filing deadlines because they depend on your revenue. For corporations, monthly and quarterly filers have 1 month after the filing period ends to file a return. Annual corporate filers typically have 3 months to file and 3 months to pay. But annual sole proprietors, those business owners who are not incorporated, can file until June 15th, but they must pay by April 30th. Wait, you need to pay before you file? Yep. Makes perfect sense, right? It gets even more confusing when you add personal taxes, corporate income taxes, and tax slips to the mix. If you find all these dates confusing or don't know what they are, I recommend watching one of my next videos in the series dedicated to Canadian businesses, where I summarize and simplify all those filing Canadian deadlines. You can file your sales tax return electronically through NetFile or through your business account with CRA. There are also multiple ways to pay the balance. You can pay online online, set up pre-authorized payments, or do it through your bank. There's more information in the description. Keep in mind that the government may request supporting documents or review your claims before issuing a refund, especially if it's a significant amount or if you're a new filer. So stay tuned as I'll explain how to better prepare yourself for CRA review in the next section. But wouldn't it be easier for the government to just collect the sales tax instead of forcing businesses to do their job for them? Let me know in the comments what you think. Also, please let me know if you're finding this video helpful or not. I really try to improve the channel in these videos, and for me, it's not so much about getting as many likes as possible, but really improving. Your feedback or even criticism is extremely valuable. Now, let's talk about everyone's favorite thing in life: getting audited by CRA. Just kidding. But understanding how audits work can save you thousands in penalties and interest and a lot of stress. CRA has three main ways of reviewing your GST HST filings. First is the refund review. If you're claiming a refund, especially as a new filer, CRA might ask for evidence before releasing your money: invoices, receipts, bank statements, and so on. They want to make sure you're not gaming the system. Second is the desk audit. CRA chooses specific lines on your return that look suspicious to them. Maybe your ITCs seem unusually high, maybe your collected taxes don't add up to a nice around 5% GST, maybe your revenue doesn't match what you filed on your corporate tax return. They will send you a letter asking for explanations and supporting documents. Third is the field audit. This is the big one. CRA comes to your office, or does it virtually now, and goes through everything: general ledger, sales journal, purchase journals, bank statements, contracts, import documents, even your accounting software setup in some cases. Field audits usually happen when CRA has serious concerns about your business operations. CRA can audit up to 4 years back from your last assessment. But if they find misrepresentations due to neglect, carelessness, willful default, or fraud, that 4-year limit disappears. If your records are incomplete, CRA might extrapolate results from a small sample to your entire filing period. That rarely ends well for the business owner. So what do they usually find? The most common issues from my experience are missing documents to support numbers, as well as charging incorrect sales tax rates or not charging sales taxes at all, or confusing zero-rated, exempt, and fully taxable sales and underlying ITCs. If CRA believes your filing was grossly incorrect with intent, they can go back further to test other things. If they reassess your return and decide that you owe more taxes than you filed, you can still dispute the conclusion. Depending on the complexity, you could work with an accountant or a tax lawyer. But I don't recommend dealing with CRA yourself unless you have experience in accounting, taxes, or communicating with CRA. CRA agents have a certain way of looking at things that isn't always intuitive to non-experienced people. We've seen multiple times where business owners trying to resolve situations themselves only made it worse. CRA has 3 types of penalties: administrative fees, late filing penalties, and interest. Administrative penalties apply to things like sending paper filings when electronic filing was required, or failing to file when requested, or making false statements. Penalties range from minor fees like $100 to substantial amounts up to 10% of the reassessed amount. Late filing penalties apply when you file late with a balance owing. The penalty starts at 1% of the unpaid amount plus 0.25% per outstanding month up to 12 months. Interest is charged daily on all outstanding balances and late installments at the prescribed interest rate. But if you overpaid installments to CRA, they will also pay you back, although at a much lower rate than what applies to penalties. Prescribed rates regularly change, so check the CRA website to stay current. Links in the description. It's also important to remember that sales tax penalties and interest are added only on outstanding balances. So if you're supposed to get a refund, even if you file late, you won't get a late filing penalty or interest. But I still recommend filing your taxes on time. Less headache in the long run. Unpaid sales taxes are scary. The government goes aggressively after them. If you're a corporate director, you are personally liable for unremitted GST HST. CRA considers unremitted GST HST to be trust funds, which means essentially you're holding government money on their behalf. So they can garnish your wages and even put liens on your personal property outside of your corporate assets. But there are ways to fix problems. If you find yourself in a difficult situation, I strongly recommend that you speak with your accountant first, ideally someone who has experience dealing with sales tax complications. If CRA hasn't discovered the problem yet, you can use the voluntary disclosure program before they contact you. If you disclose unfiled returns or underreported taxes, you can get substantial, if not full, penalty and interest relief. You can also file adjusted returns to correct errors in rates or omitted sales, or even add expenses you missed previously. Ideally, you do it within 4 years, because any adjustments older than 4 years are a bit more complicated and not always guaranteed. The key is being proactive. If you know there's a problem, I strongly recommend not waiting for CRA to find it first. By the way, have you ever had any issues with GST or HST? How did you end up fixing it? It would be great if you could share your experience in the comments, and hopefully it can help somebody else avoid a similar problem. Now, let's cover some practical tips that can save you time, money, and prevent headaches. First, make sure your record keeping is perfect. Keep all source documents for up to 6 years, even when filing electronically. I recommend going fully digital. Multiple platforms now let you take pictures, upload and store receipts and other documents online. They can handle email invoices and quickly convert bank statements while connecting directly to your accounting software. Most accounting platforms, such as QuickBooks Online or Xero, offer some functionality, but specialized accounting automation platforms like Dext typically perform better. Make sure your invoices and your supplier invoices include all the details we discussed early in this video. Second, use tax modules in your accounting software. We've spoken to many business owners who were tracking their sales in Excel. That was one of their least favorite tasks, and a very time-consuming one too. You could save hours if you correctly set up the sales tax module in your accounting software. All your return lines will be calculated automatically. Even if you have a mix of exempt and taxable sales, you can still use the sales tax module effectively by creating custom sales tax rates. Use product and service items with default tax codes instead of entering them manually for every invoice. Also, be careful about mixing up out-of-scope, zero-rated, and exempt categories. They mean very different things in the sales tax module and for audit purposes as well. Exempt only applies to a sale that is exempt. Out-of-scope is the category you apply to an expense that does not have Canadian sales tax attached to it. And zero-rated applies to sales that are charged a zero tax rate, as we discussed earlier. Don't use one generic 0% code for both zero-rated and exempt sales. I also recommend reconciling your GST/HST accounts frequently to catch errors early. After you file a return, I recommend locking your period. If you need to make adjustments, do so in future filings instead of editing items in the periods that have already been filed, because that can make it very confusing for your accountants and CRA. Third, consider using the quick method to save time. The quick method works well for certain businesses with low expenses and less than $400,000 revenue in 4 quarters. There are some minor nuances. I left the link with more information in the description. Under that quick method, you charge normal GST/HST rates but remit a lower percentage of your gross sales. You don't need to track ITCs on operating expenses separately anymore, because it's handled by a simple formula. For example, if you sold $100,000 in services last year, you would still charge your clients in Ontario 13% HST. But for your quick method filing, you would apply an 8.8% rate to your gross sales plus HST. That's $100,000 plus 13% HST times 8.8%. This means you need to remit about $9,900 to the government, not the $13,000 if you use the regular method. And you can still claim ITCs on capital purchases like equipment and vehicles while still using the quick method. However, under the regular method, you would also deduct ITCs from that $13,000 collected HST, reducing the net amount. Under the quick method, there is no such deduction. So in some instances, quick method is better, and sometimes the regular method would result in a lower tax remittance. If you're not sure which method works best for your company, I recommend speaking with your accountant about it. Fourth, manage your cash flow. As discussed before, I recommend opening a separate bank account for your sales taxes. Move the tax portion from each deposit to that account until you remit to CRA. It helps to psychologically not think about that money as yours. You can also set up a pre-authorized debit in your CRA business account to make payments easier. You can check the link with the instructions in the description. If you get refunds regularly because of exports or zero-rated sales, I recommend filing more frequently to get your money back faster. And finally, close your GST HST account if you don't need it. If you close the business or change from taxable to exempt sales, close your sales tax account. Simply not having qualified sales is not enough to stop filing returns. Even with no taxable sales, CRA will still expect you to file returns on time. And if you don't, they can assess taxes for you, usually incorrectly, and will keep bugging you until you pay that artificial amount or file your returns that would show that you don't owe them anything. In this video, we covered a lot of ground, from the GST HST basics to the registration process, filings, risks, and practical tips. As you can see, sales taxes in Canada can get very complicated very quickly. But if you understand the fundamentals we discussed today, you are already ahead of most business owners. Speaking of staying ahead, we just started a new Facebook community for business owners to help with business-related questions. Feel free to check it out, join, ask questions, or help others if you can. I left some additional details about it in the description. I've also put together a basic reference sheet with some current tax rates, filing deadlines, technical terms, and some useful CRA links. It also covers a few basics on provincial sales taxes like PST and QST that we didn't discuss in this video. The guide is completely free and it might save you a few minutes of searching online. You can find the link below. If you found this video helpful, please share it with somebody you think might benefit from this information, and let me know if there's any particular topic you'd like me to cover in future videos. Thanks for watching, don't forget to subscribe, and see you next time.